for legal purposes, don't take any finance advice from me. Invest at your own risk. Alright, today I'm gonna teach y'all how to make that quick milli. Yes. So basically you can have like kind of like any kind of job, but like you just need to be good with money, you know? So like you need to like learn how to not spend money, but like kind of spend money at the same time. So like there are ways you can do this. So like you get a paycheck. Yes. Okay. Paycheck, and you split it up. Spending and saving. If you want to secure the milli, y'all is gonna have to like save your money. You know, you can't just like spend all your money. Yeah. So like this person, the 60K person, invests like half their money. Paycheck, and then like split it up in some way. So like person A split up they get like paid like $250K a year. They save 10% of each every year. They invest or save 10% of their money, and they only have like left like 25K. Well, this person makes like 60K a year, and they invest half their money. It's like 30K. And so like over like the next 10 years, person B would eventually have more money than person A because they saved their money or invested. So they'd be like worth more because they save their money, you know. Investing is basically like putting your money into things so that your money like makes more money for you without having to do like physical like labor or like actual like work kind of. And so you can invest in like stocks. I don't even know if you know what a stock is. Stock is like a percent of a company. There's like all sorts of different stocks to all the different companies and stuff. And there's like stuff called like ETFs. An ETF is an exchange transaction fund. And so it's like multiple, in simple terms, it's like multiple stocks but in one. So let's say you want to buy Apple and Google, you know, like there's like a stock that like might have both of those, you know, like an ETF, that's what they're called. It's like a package, you know, you like want to own both, but like for like maybe a lower price or higher price, you know, instead of buying like both stocks, you know, you can just buy one that has both for a different price. So you own like a percentage of each one. There's also real estate, but I'm gonna tell y'all how y'all can like make a quick milli though, or not quick milli, but like guarantee you that milli. Alright, so yes, I'm not gonna learn how to manage your money. Let me show y'all. Alright, so we're on Google right now. Yeah, so this is basically SPY, also known as like Spider. This is like one of the ETFs you can like invest in and stuff. And so basically this is kind of like basically America, a portfolio already set up for you for stocks. Here are like their top like holders. This ETF contains 7.17% of Microsoft, 6% Apple, 4% Nvidia, around 4% Amazon. It's a lot of tech companies, but like technology. Oh yeah, we already said technology. Healthcare stocks in there, industrials, like oil companies, military companies, consumer goods, oil and gas, utilities. It's like a bunch of random stuff.
$44 a share. I don't know. I think it's way longer than that, but like I don't know, it's a little saving right now on Market Watch. And so as you can see, this is basically like the American economy.
SPY basically like
Picks and chooses. These aren't like the same stocks they hold like forever. If a stock is like not performing very well, they like remove it from like the ETF.
the reason why it says 500 ETF is basically there's like it's like the 500 like kind of like top companies all in like one stock. They just keep switching out like the best ones that like, will like grow everyone's like people invest in their stock or ETF the most like money, like most return ROI, return on investment.
You invested like $44 in 1993. At $44 slowly it goes up and down, like because there's like recessions and stuff. Recessions like basically like when like the economy is kind of bad, like after an event or something. This is like 2008. There's a stock market crash. It goes back up. American economy is like booming. Goes back down after COVID. Goes back up. A little slowdown in 2022, but it's still going back up. As you can see, it keeps going up and up, you know, and like no matter how far it goes down, like it always like goes back up. And so basically, it's kind of like guaranteed because like America, there's like a lot of like competition, so everyone is like competing against each other for like making better and better products, which like gets people to like circulate like more money into the economy and buy these like products, and that's why like, some of these like stocks like go up like crazy.
Oh yeah, stocks basically go up when people buy it, and then stocks basically go down when people sell. So if like everyone bought like a stock, it'd go up like crazy, and then if everyone sold the stock at the same time, it could drop to like zero. I doubt everyone on earth is gonna sell, or in the US at least, is gonna sell all their stocks with like SPY. Maybe like after like news or events. SPY's annual return on investment is an ROI, return on investment, of 10.26% annual return rate in the last 30 years. So basically, if you put your money into SPY, your money will grow by 10.26% every year on average in the past 30 years, which is pretty good. It's like Legos, you know, like the multipliers, like when you pick, so like the more you invest, like there's like also compound interest, dividends and stuff. Compound interest is basically when you earn interest on the money that you saved on the interest you earned along the way. It's like investing more and more and more of your money, like an emergency happens, or if you just want to get rich in the future, you know, like. But as you can see, the snowball, like when you first start investing, is like very small, and then the more, like over time, it starts to like grow, like that SPY graph, and more and more money. So you add your first income from your site, and then you add more money to it. It gets bigger, and then bigger, and then bigger. So basically, it's kind of like if you like would add a couple $100 to your investment portfolio every month or something like that, or for like a couple years. Basically, dividends are basically like when you like hold stocks, pay you for like owning their stocks. So like, because like when you invest in companies, you're basically like giving money to these companies to like use or spend and like help grow their company. And so basically sometimes like they pay back their investors in something called dividends, where like the distribute of like corporate profits to qualified shareholders are as determined by the company's board of directors. So people get like money for holding stocks, you know, but like you get more you get more dividends, or a higher amount of dividends, like the more stocks you like have or own, or something called shares. Shares are basically like the number of stocks, or the So one share of like, let's say a random stock is like $500. And so if you say, oh, I want 2 shares of that stock, 2 shares equals like $1,000, you know? Because like, you paid for 2 shares. The share is basically the quantity of stocks that you own. But like, you can also, on some investing platforms like Robinhood, you can like invest in like small percents of like a company. You don't have to buy a whole share, because sometimes like $500 could be a lot of money, but you can invest in as little as like $5 or $15, like a week or something or less. You can like invest like in smaller portions compared to like E-Trade. You might have to buy stocks and shares, where you have to buy like maybe a stock by this whole price every single time, which can be annoying. Earnings yield, stocks like sometimes like have earnings which like basically represent the performance of how the company is doing, and basically sometimes like the higher that number is, like after like release of like the higher percent of like ROI the company has, or it kind of represents like their success. So basically the higher the number is, like the more like it encourages people to like invest in their company and says like, oh, we're gonna do well, you know, we should invest in our company. If like earnings are bad, the stock might go down, but it could really go either way. Like dramatic impacts on stocks, like volatility is basically like great like change in a stock, like you go like really high up or really down, like really far down. And yeah, and so basically with SPY, annual percent yield of SPY is 10.32% on average over the past 30 years. That percent. So this is kind of like a graph of like basically you when you start investing when you're 18. If you invest like $500 a month, see how that like that compound interest, like that big snowball curve, just dramatically shoots up. If you invest $500 a month starting with $0, your total contributions would be like around 280K, and then by the time you pull that money out of the stock, or by the time you retire, this is from 18 years old to 65. That's basically by the age like people in America retire, and so you'll have like 6.1 mil by the time you retire, and then if you did 1,000, you'd have 12.2 mil by the time you retire. So basically, like you're securing that $1 million. Oh yeah, you just put 500 grand in. But if you just put that 500 grand in at the start, it could be a lot higher, because like basically time is like your greatest enemy, and so you basically want to invest as soon as possible. Even your future children, like if your child is like really dumb, or like is like, I don't know, not really dumb, but like maybe like if your child maybe it's like a backup plan just in case like they fail in life, if they get no job, they have they don't do well in school, or like maybe they have no future, you know, like maybe like you don't want your child to go freaking homeless, you know, like when you like retire. You can invest for your children with like a joint account, so they basically can like get the stock money like when they like are 18, or you just don't give it to them, you just invest on your account or something. Yeah, so if you invest for your child as soon as they're freaking born, by the time they retire when they're 65, they could have 36 mil. Like that is crazy. Like that compound interest really ups, you know, like. And then if you invest $1,000 every month for your child, bro, they could have 72 mil. 72 mil, isn't that crazy? Isn't that crazy? I know that is pretty crazy, you know, like your children can be rich without doing a single thing, you know. That's like why the rich stay rich, you know, because like most of them like just reinvest their money, you know. They got that cash flow circulation where like money is just like you're spending less and you're growing your money more and more. You're making your money work for you without doing the actual work. Other types of like ETFs, like QQQ. QQQ is a really popular one. Basically a ticker is basically the code name for a stock. So like it's a smaller name. It's like a nickname. They could like type or like search it up, the stock name by. Like Apple would be, if you want to invest in Apple, would be AAPL. But this one's QQQ. It's basically the top 100 tech companies, but all in one stock. It's another ETF that's like pretty popular. Tech seems to be like the most volatile, you need to have like some sort of volatility in your portfolio. Or your basically a portfolio is basically like all your eggs in like a basket, kind of, a different bunch of different eggs in a basket that like help you grow your money. And yeah, QQQ is a popular ETF. Tech, because like you need tech like ETFs kind of, or tech stocks, because if you have no risk, there's going to be no reward. You need to have some sort of risk in your portfolio to get you the most amount of cash, if you want to be the most rich. Because if you invest in like something like gold, dude, gold is so poopy. It is so bad, gold. I mean it's something safe, but like it's like not that volatile. Like there's not that much reward. If you invest in like SPY or like any other stocks, like there's a lot more reward. It's like the safest thing if you are very scared of like losing all of your money, because like you can't like print more gold. You can find more gold, but like it's like harder to inflate. 5 types of investors, 2020 study by Charles Schwab. Peter Perfect, invest at the perfect time. Ashley Action, invest as soon as she gets her money. Matthew Monthly, invest it money evenly every month. Rosie Rodden, invest at the worst time. Larry Linger, he just leaves his money in his bank account. He doesn't even invest or anything. If each person was given $2,000 for 20 years, here would be the results. They're pretty interesting. Ashley Action, she doesn't even time the market perfectly, and she's almost as close as Peter Perfect, who times it perfectly. Like it can be really hard to time the market. You basically like the simple formula is just to invest at the lows and then sell at the highs. That's basically all it is. It's like that simple. Like you basically kind of like want to have like cash on the side to just like invest in like when the stock market goes down, because the stock market always goes down, but it always goes up back up greater. So actually should probably invest like at the worst times, but still. Or Rosie Rodden does it at the worst times. Like when the stock is like super high, she invests at those. Her money is still up. It's only like 10-15 grand away. Matthew Monthly invests like monthly. It's pretty close to Ashley Action. And Larry Linger, of course, is at the bottom. Bro did not invest his money. Bro did not get his money up. You don't want to leave your money in your bank account. You want to invest it. You never want to have like too much money in your bank account sitting there. Otherwise, like your money's not doing anything. Why don't you have your money do something for you? Another reason why you want to invest in ETFs is that if like one stock in the portfolio fails or goes to zero, like the stock still stays up, because like there's 499 other stocks. But like if you had all your money in one stock and that one stock failed and went to zero, all your money's gone. But like if you invest into an ETF, basically your money basically just you'll be chill. Like you won't lose everything. It's a lot more safe if you're investing in multiple companies than just like depending all your money on one. But there can be like more return risk. There has to be some risk, but like that's a crazy amount of risk. But like you might have some crazy returns. Like if you invested all your money in Nvidia, which is a tech company, not too long ago, it was like $300. Now it's like $900. Like you have some crazy money. But another ETF I recommend is this one. It's called EWJ, and it basically is a Japanese ETF of tech companies, like Japanese tech, and it basically has the top 10 holdings are Toyota, Sony, Toyota, Electron, Sony, Hitachi, Mitsubishi. It's a bunch of random tech Japanese companies. This one might be the next move, because the yen is like at an all-time low right now, and so the Japanese economy is kind of like really low. So basically, if you're investing at the Japanese when the Japanese economy is like super freaking low and it goes back up, like you could have some crazy bank. Like this ETF could pop off. It didn't even start like too long ago. It started in 2000, and comparing it to the US ETFs, like they've shown like really positive like growth. We have our cash flow here. Basically this is like your income. So your income goes through here, and then it could go all the way out to your expenses. Like if all your income goes out to your expenses, you're gonna be broke. And so if your money goes into liabilities, you're gonna be even more broke, because you're basically spending your money on things that will just cost you more money and have like not really great returns. So like a liability would be a car. A car would be a liability because you're basically you're buying the car, but then you're basically going to have to spend even more money having to repair it, gas, insurance, all sorts of different stuff. So this car is going to cost you more and more money when you buy it. So liabilities are basically things that are going to cost you more money. We can say marriage. Marriage. If someone divorces you and you have all the money, you're gonna lose like, I don't know, 50%, and you have like kids and stuff. What? Like, you're gonna lose all your money, so that's a liability. You could like end up spending more money on relationships and stuff, and like losing it all on marriage. So like when they divorce you, they take all your money, but like definitely did not happen with my parents. All right. Anyways, car, marriage. What's a liability? Well, a house wouldn't be a liability. It'd be more of an asset because, or properties, or multiple houses, like complexes or houses, because you're investing your money into these properties, and just basically by owning them, it's like stocks. Like it builds up. Depending on the location, or if you like repair it, the value of the property increases over time depending on location. You gotta choose a good location. If you choose a bad location, it could decrease. But yeah. So basically, this could generate you more assets, and then like more, and then you can put some into the expenses, or put it back into the assets that generate you more income. These assets generate you basically more and more income. Could be land, could be ETFs like we already talked about. Be art. Art's a good one because you invest in paintings and then you hold on to them and sell them. Cars could be an asset that generate you more income if you use them for, like, let's say DoorDash or Uber, like, but you're still gonna have to end up paying for gas and stuff. Could be gold. Invest in gold. I literally got a notification from a freaking Uber after I just said that. That's crazy. Anyways, they're definitely listening to me. Debt is a liability because, like, there's interest, on debt, and the more money, or the longer you owe money to like banks or like people, you could end up owing even more money the longer you don't pay it back. You always want to pay up all your debt, bonds, student loans. I mean, it depends. Like, if you like go to college and get a degree or something, it could get you a better job, which could generate you more income. But you still gotta like save it or invest it or something. Some of it, you can still spend your money. Like, you don't have to invest all your freaking money. With stocks, basically, there's basically it's not a quick rich scheme. There's like no like guru or like courses you have to pay for. You can just invest on just trading platforms or stock brokerage platforms where you buy shares and they buy it for you. Well, you're buying it, but like you're using their platform to buy the stocks. So there's like some that don't have like commissions or fees, like Robinhood doesn't. And there's like some others that do. They charge like a percent fee of every time you buy or sell stocks, but I recommend Robinhood is a good one for like beginners to learn, or it's an easy platform to like learn how to invest and stuff. And that is basically how you like secure that quick Milli. You just gotta just save and invest your money, and just put it somewhere where you can just grow it. You know, it's like not that hard. It's pretty simple, and people get rich off of it, and it's kind of like a job. You basically getting paychecks that you don't even have to work for, which is kind of crazy. Ben.